Morning student, today we will discuss the topic capital adjustment from the chapter retirement of a partner. See, at the time of retirement, the remaining partner may decide that their capital after retirement of a partner be adjusted. The adjustment may take any of the following forms. It means there are 5 cases. We will come across the 5 cases. Accordingly, we have to solve the question. In this video, I will cover only case 1. And of course, I will explain this topic with the help of example. And see, first I am going through all the 5 cases. You just listen carefully. First, case 1, when existing total capital of remaining partner is to be in new ratio. What do you mean by this? Means first of all you have to prepare the partner's capital account, and that adjusted capital, again you sum the capital of adjusted capital of both the partner or remaining partner, and then again same capital you distribute it in the new ratio. That we will discuss the case in detail. And case 2, when total capital of new firm is given. So what is the difference between case 1 and case 2? That is, in case 1 new capital of firm is not given. Then how you will determine the new capital of firm? That is, you just add the capital of remaining partner. Which capital? That is adjusted capital. And then you distribute the capital in new ratio, and then compare. If it is excess, then partner will withdraw the capital, and if it is deficit, then partner will bring the capital into the firm. And in second case, new firm, total capital of new firm is given. Then you have to first distribute the new capital into new ratio, and then compare that capital with the adjusted capital, and then you see the differences. If there is a excess or short, accordingly a partner will bring the cash or he will withdraw the money. See the case 3, when total capital of new firm is equal to total capital before retirement of a partner. What do you mean by this? It means ki you have to, without making any adjustment, without adjustment, the capital at the beginning, that will be compared with the capital of new firm, and then differences will be adjusted through excess or short by cash, or by withdrawing the cash, or by bringing the cash into the firm. And now see the case 4, when retiring partner is to be paid through cash brought in by remaining partner in a manner to make their capital proportionate to the new ratio. That retiring partners, here the thing is that ki if suppose there are 3 partners A, B and C, A's capital, adjusted capital is coming 1 lakh, B's adjusted capital is coming 80,000, and C's adjusted capital is coming suppose 50,000. So while sum the capital of all the 3 partners, 1 lakh, 80,000 plus 50,000, that is 2,30,000. Again make their capital proportionate to, again you just distribute the capital in new ratio. Then the retiring partners capital will be brought in by the partners, and in this way the capital will also be adjusted. That we will see the example, that the point will be very clear to you. And now then see the case 5. What the case 5 is saying, when the retiring partner is to be paid through cash brought in by the remaining partner in a manner to make their capital proportionate to the new ratio, and also leave a desired cash balance. Here the difference between case 4 and case 5 is that ki whatever cash is coming by the remaining partner, it is given to the retiring partner. And in case 5, the capital that should be brought in by the remaining partner after paying the due amount to retiring partner, if any balance, that minimum balance will be given in the question, that sufficient cash should appear in the balance sheet. So these are the 5 possible cases that we will come across across while solving the question, including the adjustment, that is capital adjustment. So now let us move to our first case in details with numericals and its solution. Then the point will be very clear to you. This is our second case. First case, when existing total capital of remaining partner is to be in new ratio. See what step you have to follow to find out the excess or short cash that is to be brought in by the remaining partner. When the existing total capital of remaining partner is divided in their new ratio, this is our first case. There are 4 steps that are to be followed. First, you have to calculate the new ratio, and suppose in the question new ratio is given, then need not have to calculate new ratio. Then you come to the second step. What is required? Calculate the adjusted capital of each of the remaining partner. That you know well. You have to prepare the capital account of the remaining partners by crediting these items that are listed here, like goodwill, reserves, accumulated profit, or any previous profit, any profit on revaluation. That all are the item of the credit side, and in the debit side, if any previous losses is appearing in the asset side balance sheet, and if drawings is made by the remaining partner, that adjustment means you have to prepare first capital account, find out the adjusted capital. This is your second step. And step 3, you just calculate the new capital of each remaining partner. How you will get the new capital? You simply just sum total of the adjusted capital of remaining partner, and then you distribute it in the new ratio. So this is our third step. And in the fourth step, you just compare your adjusted capital with the new capital. If there is a surplus, then surplus will be withdrawn by the remaining partner, and if it is mentioned in the question that you simply transfer it to current account or open the current account, that you simply write in the particulars column to A's current account to B's current account, as the case may be. Whatever is mentioned in the question, accordingly you just do it. And if there is a deficit means what? Presented adjusted capital is less than the new capital, then partner has to brought that much money to the firm, and if he is not right now, he is not bringing that cash, then it will be transferred to the credit side of current account. So this is what the fourth step is required to be followed while doing the adjustment of capital relating to the first case. Now I think this fourth step is very clear. Once again I am just repeating what step you have to follow. First, to calculate the new ratio. Second, you just calculate the adjusted capital simply by preparing the capital account. Third, you just sum total of adjusted capital of only remaining partner, don't consider here the retiring partner, and then you just distribute it in the new ratio. And then you just compare your second step with the third step. If there is any surplus, he will withdraw, and if there is a deficit, he will bring in either in cash or by involving or by opening current account. So let us discuss the same topic with example. Here one question is given. There the balance sheet of A, B and C on 31st March 2019, on the date A's retirement. This is the status of the balance sheet. Creditor given 25,000, A, B, C capital 40, 30, that is total capital 1,10,000. Land and building, here asset side 40,000. Goodwill given 15,000. This is the goodwill already appears in bookcase, so you have to write it off now. Plant and machinery 28,000. Motor car, that is 27,000. Debtors 24,000 and cash 1,000. So this is the status of balance sheet. And now see the term and conditions on which this partner A is retiring, and on that day goodwill of the firm is valued at 21,000. Second adjustment, value of land and building is appreciated by 10,000. plant and machinery is reduced by 23,000. And next adjustment, again you have to create the provision at the rate of 5% on debtors. Fifth case, reduce the creditors by 700. Now sixth case, total capital of newly constituted firm will be readjusted by bringing in or paying off cash, so that the future capital of B and C in their new ratio 1:1. I think this question you are getting that the new ratio is also given, no need to calculate the new ratio. And here the total capital of new firm is not given, then you just do sum the capital of adjusted capital of remaining partner. And the seventh adjustment is given, amount payable to A shall be paid after 2 years, and till that time it will remain in the business as a A's loan bearing interest 12% per annum. And A decided, this is what the value based question. So nowadays CBSE don't ask value based questions, so if you wish you can give the answer, otherwise we will attempt only the numerical part. See here, this settlement of account I already explained in the previous video, where how the retiring partners accounts are settled and how you will represent the retiring partners loan account. That topic I already explained in the previous video. And see, this is what the position of balance sheet along with this adjustment. Now just move to the solution. Here the revaluation account is prepared. This is the revaluation account, revaluation account that decreases in the value of asset, increases in the liability. Here land and building is increasing, decreases in the liability. That you have to prepare the revaluation account, that I already explained how to prepare the revaluation account. So this question, how these revaluations are shown, it is represented here. Then you move to the partners capital account. See, first how you will do this, revaluation profit is transferred to the partners capital account in the credit side. And this is what the goodwill, here the goodwill part also we have already covered. This goodwill is to be borne by B and C, remaining partner in the gaining ratio. That is AB is bearing 3,500, C is bearing 3,500, and this same amount is debited in the B's and C's account, and in particulars column it is written A's capital account. I think this is clear to you. How you will calculate this? Gaining ratio is 1:1 while calculating, and C's share of A's share of goodwill is 7,000, and this is to be adjusted. Here in the working note it is shown, and this way it is represented in the partners capital account. Now then what you have done, that you have written off that the goodwill that already appears in the balance sheet in the debit side. That part also I have discussed, how you will do the treatment for the goodwill at the time of retirement of a partner. And then in the next step, what you have done, you just find out the adjusted capital. In the credit side, B's total balance is coming 41,500. Okay, and out of this 41,500 you have deducted 5,000 and 3,500. Here it is shown. This is the way how you will find out the B's capital. It is coming 33,000, and this 33,000 is the adjusted capital. And again what you have done, this new capital is 56,000. How it is coming? By adding the adjusted capital of B and C. See here, 33,000 it is the adjusted capital of B, and 23,000 is the adjusted capital of C. then what step you are following? First, already new ratio is given, no need to calculate. Then in the second step you are just adding the adjusted capital of B and C, that is coming 56,000. And then in the next step what you are doing, this 56,000 is distributed in the new ratio and it is coming 28,000 and C is 28,000. And then you are comparing this new capital with the adjusted capital. Here what is the situation? New capital of B should be 28,000, but it is coming 33,000. It means B is having a excess capital 5,000, so he has withdrawn from the firm, so it is represented in the debit side to cash 5,000. Okay, and see now the case of C's existing adjusted capital is coming 23,000 and his capital should be 28,000 as per the new capital. So there is a shortage of 5,000, so C is bringing cash by 5,000 and it will appear in the credit side of the 5,000. Okay, so this is the way how you will show your numericals, do your adjustment in the partner's capital account and find out this correct amount, by what amount there is a deficit or by what amount that surplus money is coming and it is withdrawn by the firm and it is brought in by the firm by C. And now you will make a new balance sheet. That creditor there is 24,300 because there is a decreases in 700, so that's why it is reduced. See in the balance sheet what was the position? 25,000, and in the new balance sheet it is reduced by 700. And A's loan that is coming 43,500, so it is transferred to A's loan account. And here the prefixed by 12% because on this loan firm will pay 12% interest. And only two partners remained in the firm, so B's and C's capital 28,000. This is a new capital of a firm. And similarly here the changes in the value of assets, accordingly revised values are shown in the liability asset side of the balance sheet. Land and building 50,000, plant and machinery 23,000, and this motor car 27,000. New debtors, see here the debtors provision for doubtful debt is created 1200, so it is the gross debtor is 22,800. And cash balance, because there is a 5,000 brought in by the C, so it is added to the cash balance, and again 5,000 is withdrawn by the B, so again the balance is remained same 1,000. So this is the way how you will solve the questions based on the topic that I already explained. This is our first case. When new capital is not given, you simply add the capital of adjusted capital of remaining partner, distribute it in the new ratio, then compare the adjusted capital with the new capital, and this way you will do the adjustment of capital. As I said, out of this 5 cases, I discussed our first case. So this is all about the topic, what I explained. Okay, and you just note down all the notes what I am providing step by step, so it will be easy for you to attempt the questions relating to the topic, that is adjustment of capital. Thank you so much and take care.